Welcome back to Investing Talk Podcast. Today we're tackling a question that's definitely been on many of your minds, and actually this one came directly from a listener. Is Paramount Skydance a good time to buy right now? We've been digging through quite a stack of sources for this one. We've got detailed investment assessments, timelines of that whole recent merger drama, you name it. Our mission today is really to pull out the most important bits, give you the crucial numbers, and help you understand, what the experts are actually saying about this evolving media giant. Before we jump into the details, just a quick reminder, if you're finding value in what we do here, please think about subscribing, maybe liking the video, leaving a comment. Your engagement really does help us bring these analyses to more people. And if you're able, you can also support us by buying us a coffee. Plus, definitely let us know if there's a specific company or maybe a topic you'd like us to look into next. Just drop it in the comments below.
That's exactly right. And our goal today is to give you a clear, sort of concise picture of where Paramount Skydance stands right now. Its recent journey, which was quite something, and the expert consensus on its investment potential, all without feeling, hopefully, too overwhelmed. So to really get at whether it's a buy now, I think we have to start by understanding how this new company even, came into being.
Okay, yeah, let's unpack this. Paramount Skydance. It's a relatively new name, right? Officially formed just this year, August 7, 2025. But getting there, becoming a single company, that was anything but straightforward. I heard it was quite the corporate soap opera.
Oh, you're not wrong there. What's really fascinating, I think, is just the sheer complexity and, honestly, the drama of that whole merger process. It wasn't just a few months. It was like over a year of intense back and forth negotiations, twists, turns.
So take us back. How did Skydance even get into the picture initially?
Okay, so it kicked off in early 2024. Skydance Media, that's led by CEO David Ellison, they entered exclusive talks to acquire National Amusements. And National Amusements, that's the holding company controlling Paramount Global. The initial deal proposed was pretty substantial, $2.25 billion for National Amusements itself, then another $4.5 billion in cash, specifically for Paramount's Class B shareholders. And Skydance would also assume $1.5 billion in Paramount debt. So Paramount Special Committee, they gave a preliminary thumbs up in late May 2024. Looked like it was moving.
Sounds pretty solid on paper. But then things took a sharp turn, didn't they? Quite dramatically, from what I recall.
Yeah, absolutely did. It was quite stunning, actually. Yeah. Just days after the terms were supposedly all finalized, this was around June 3, 2024, the National Amusements chair, Shuri Redstone, she unexpectedly withdrew her support. That was June 11th. And she cited concerns about, both the valuation and the deal structure.
Wow, okay. So that must have just derailed everything.
Instantly. Months of work. Just paused. But, the story didn't end there. After a really brief pause, talks actually picked back up pretty quickly. And that led to a new three-way preliminary agreement by July 2nd, 2024. This revised deal reportedly had stronger protections for the minority shareholders and also increased the cash part of the deal. Paramount's board formally approved that one on July 7th, and then a 45-day go-shop period followed, to see if any better offers came in. But none did.
And wasn't it just internal drama? Weren't there other big players trying to jump in from the outside? Kind of makes you wonder how competitive that whole media M&A space really is.
Oh, absolutely. You're right to ask that. The competition for these media assets is, incredibly intense. Several outside parties definitely tried to muscle in, maybe derail the Skydance Paramount thing. Apollo Global Management, for instance, they made a huge $26 billion all-cash bid. But crucially, it didn't have Shari Redstone's backing.
Right, which was key.
Exactly. And then Apollo even partnered up with Sony Pictures later on a joint proposal. The idea there was basically to split Paramount's assets. But that also stalled out. There were complex regulatory issues, operational concerns. It just got messy. And there was even a $30 billion offer floated by Byron Allen's Allen Media Group. Though, honestly, that was largely seen as, let's say, unrealistic, mainly due to financing questions. So in the end, none of these other bids really gained any serious traction.
That level of intensity, all those bids flying around, it must have put immense pressure on Paramount's own leadership, right? What was happening at the top during all this chaos?
Oh, absolutely. The merger chaos definitely led to significant turmoil right at the very top. Bob Bakish, the longtime Paramount Global CEO, he was removed in late April 2024. And sources were suggesting his handling of the merger talks was, a key factor in that decision. Yeah, and then in a really unusual move, the company installed this three-person office of the CEO on an interim basis, kind of a co-CEO setup, really designed to, stabilize things and keep the divisions running while all the negotiations were dragging on. That structure actually stayed in place right until the deal officially closed. It just highlights the kind of immense pressure and complexity happening at the executive level during these huge corporate maneuvers.
So after all that back and forth, the rival bids popping up, leadership getting shuffled, how did this deal finally manage to cross the finish line? It sounds like it almost didn't.
Well, it faced major regulatory hurdles right up until the very end. Even after the SEC and the European Commission gave their okay back in February 2025,
Hmm.
there was still ongoing scrutiny from the Department of Justice and especially the Federal Communications Commission, the FCC, that really delayed the final clearance.
The regulators,
Yeah.
always a factor.
Always. Paramount even had to trigger a 90-day extension clause, pushing the closing deadline out to July 7, 2025. The FCC finally granted approval on July 24, 2025, and it was a close vote, 2-1. And they didn't just approve it. They imposed several conditions, things like appointing an internal ombudsman to monitor content neutrality.
Interesting.
Yeah, and commitments to scale back some diversity, equity, and inclusion initiatives, plus guarantees of fair access to news platforms. So finally, on August 7, 2025, the merger officially closed. Paramount Skydance Corporation was born. David Ellison was appointed chairman and CEO, and Jeff Shell, the former NBC Universal exec, he became president. And they immediately reorganized into 3 core divisions: studios, direct-to-consumer, and TV media. And of course, started trading under the new ticker.
Wow, what a journey, seriously. From those initial talks, the collapse, the rival bids, leadership changes, regulatory hoops, it really does sound like a corporate saga. But all that drama kind of begs the question, doesn't it? Does such a tumultuous birth lead to a strong future? So let's pivot now from the how it got here to the really crucial part for our listeners. Is it worth investing? Given all this backstory, what does our assessment actually say about buying now?
Well, it's a great question. And despite that recent merger finally happening, the company really faces some considerable challenges in the current media landscape. It's tough out there. When we look at their fundamentals, okay, Paramount Skydance reported revenue of $28.76 billion over the trailing 12 months. That sounds huge, right?
Yeah, it's a massive number.
It is. But they also reported a net loss of $14 million in the same period. Now, while that loss is, relatively small compared to the revenue, it's a definite warning sign. They're effectively running on fumes, you could say, fighting this uphill battle against rising production costs. And of course, the huge shift away from traditional TV, the whole cord-cutting phenomenon. It means their profit margins are incredibly thin. That signals ongoing profitability challenges. It's just tight.
So they've got these strong, really recognizable brands: CBS, Paramount Plus War, MTV, Nickelodeon. But they're clearly in a very tough fight. It almost sounds like a classic legacy company struggling to adapt quickly enough.
That's a good way to put it, exactly. Their competitive position is significantly challenged by that rapid migration from traditional TV to streaming. They're up against dominant players, giants with really deep pockets, and the cost of creating content just keeps going up across the board. Analyst commentary highlights, yes, there's strategic divots towards streaming, but it also really stresses the uphill battle they face just to maintain market share, let alone improve those razor-thin margins. Now, on the plus side, we don't see immediate evidence of a crushing debt overload, which is good.
Okay.
But the stock's low trading liquidity is definitely a red flag. On August 15th, 2025, for example, it ranked a pretty low 433rd.
Right. You mentioned liquidity. Can you break that down? What does 433rd actually mean for someone listening, thinking about investing? Why should they care about liquidity?
Sure, think of liquidity like, well, imagine trying to sell a very unique, maybe niche antique car. It might be valuable on paper, but finding a buyer quickly at a fair price, that could be tough. Paramount Skydance's stock faces a kind of similar challenge. Ranking low, like 433rd, means there aren't as many buyers and sellers actively trading it compared to more popular stocks. So what this means for you, the potential investor, is it can be harder to get in or out of the stock quickly without significantly moving the price against you.
Okay, so it adds risk.
Exactly. It adds another layer of risk, especially if you're thinking short-term trading.
Got it. Okay, so shifting to valuation then, how does Paramount Skydance stack up? Are the numbers suggesting it's cheap or expensive or?
Well, this is interesting. The forward price-to-earnings ratio, the PE, is 6.58.
That sounds low.
It is incredibly low. And a number like that doesn't just whisper, it kind of screams market skepticism. Investors are essentially looking at it and saying, look, we don't really believe your turnaround plans are going to significantly boost earnings anytime soon. And to underscore that point, the trailing earnings per share is actually negative at over 2 cents. Plus, there's no positive trailing PE because they haven't been consistently profitable recently. So all this suggests their current profitability is extremely fragile. It makes it look less like an undervalued gem and maybe more like a deeply uncertain bet right now. The price-to-sales ratio is also quite low, around 0.52. Both these metrics really reflect those deep market concerns about ongoing profitability and just the general headwinds facing the whole sector.
Okay, so deep skepticism reflected in the valuation. Given that, what are the analysts saying specifically about the price target? Are they seeing upside from here, or is caution still the main theme?
Caution is definitely still the prevailing theme among analysts. The average price target right now is $10.50.
10.50, but it's trading higher than that now, isn't it? Around $14.
Exactly. So that $10.50 target represents a significant potential downside, about negative 23.47% from recent prices. It indicates that most analysts actually believe the stock is still overvalued, even after the declines it's already seen. And reflecting that, most analysts are maintaining hold ratings. They're basically sitting on the sidelines. You're not seeing strong buy signals here. It's very much a wait-and-see approach.
All right, let's dive into the technicals then. How has the stock actually been performing on the charts recently? Any technical signals we should be aware of?
Well, looking at recent trading, Paramount Skydance has been bouncing around in the $13.66 make time at 60 cents daily range. The 52-week range is wider, of course, $9.95 on the low end, up to $17.53 on the high end. The recent close, near $14.38, is pretty close to its recent lows. That suggests there might be some technical support holding around that $13 to $14 level. On the upside, resistance probably lies in the $16 to $17 area.
And volatility, is it a palm stock or a jumpy one?
It's definitely on the jumpier side. The stock is showing elevated volatility measured by its beta, which is 1.19.
Okay, beta 1.19. For listeners maybe not familiar, what does that number tell us? How volatile is that?
Sure. Think of beta as measuring how much a stock tends to dance when the overall market plays music. A beta of 1 means it moves roughly in line with the market. So a beta of 1.19 means for every 1% the broader market moves, up or down, Paramount Skydance tends to swing about 1.19% in the same direction. Basically, it's about 19% more volatile than the average stock. So it's potentially a wilder, bumpier ride for investors compared to the market overall.
Gotcha. More risk, more reward potential, maybe?
Potentially, but also more potential for bigger losses. And adding to the concern, the recent price action on the charts actually skews bearish. We're seeing signs of heavy selling pressure and notably slumping trading volume. Generally speaking, those are considered negative short-term signals for potential investors.
Okay, negative technicals. Any recent news or shifts in overall market sentiment that are impacting the company specifically?
Yeah, there was a notable drop just recently. On August 15th, 2025, the shares fell 4.59%. And importantly, that happened on their lowest recent liquidity day, which, as we discussed, kind of indicates a lack of buyers willing to step in and support the price.
Right, that liquidity issue again.
Exactly. And as we mentioned, most analysts are just reiterating those hold ratings. Some have even lowered their price targets further, down into the $10 to $12 range. So market sentiment generally remains quite negative. It's being driven by those broad industry challenges, continued cord-cutting worries, overall earnings volatility that really impact not just Paramount Skydance, but the entire media sector right now.
Okay, so the picture looks pretty challenging. But are there any potential catalysts on the horizon? Anything that could realistically change this negative narrative for Paramount Skydance, either short term or maybe longer term? What could give it a boost?
Well, in the short term, the next earnings report is definitely something to watch. That's scheduled for October 31st, 2025. That could certainly provide a trading catalyst, especially if there are surprises. Also, any updates on their streaming subscriber growth numbers, announcements about new content launches, or maybe details on restructuring plans coming out of the merger, those could excite the market.
And longer term?
Longer term, the success of those strategic pivots towards streaming and content partnerships is key, especially realizing the potential synergies they hope to get from the Skydance merger. If those start to show results, that could be beneficial. And then there are macro factors. Things like maybe a stabilization in cord-cutting rates, or perhaps even future industry consolidation. More mergers and acquisitions could potentially lift the whole sector, including Paramount Skydance.
Makes sense. But of course, with any investment, there are always risks involved. What are the key hurdles or dangers that Paramount Skydance faces right now?
Absolutely. There are definitely significant risks. Stock-specific risks include those persistently thin profit margins we talked about and that negative net income. There's a very real risk of continued losses if their crucial pivot to streaming doesn't gain enough traction or proves too costly. They also have high exposure to rapidly shifting consumer media habits, how people watch content, and the escalating competition for that content, which directly hits their bottom line.
And broader risks.
From a broader perspective, yes.
Yeah.
The entire traditional media sector is under pressure from ongoing cord cutting, the increasing costs of producing high-quality content, and declining traditional advertising revenue. And specifically for this stock, the higher volatility, that beta of 1.1, and the low liquidity we discussed, can definitely amplify short-term price swings, making it a riskier proposition, particularly for investors seeking stability.
Okay, so if we pull all these threads together now, the merger drama, the financials, the valuation, analysts, technicals, catalysts, risks, what's the final investment thesis summary for Paramount Skydance based on everything we've looked at?
Well, consolidating all that information, the overall rating from our sources comes out as a 4 out of 10.
4 out of 10? Not great.
No, not great. While Paramount Skydance does appear deeply discounted if you just look at certain fundamental and relative valuation metrics like the PE, that potential value is seen as being significantly outweighed by some major factors. Those big industry headwinds, the persistently thin margins, the bearish technical signals on the charts, and importantly, the analyst consensus price targets, which actually imply further downside from current levels.
Right.
Add to that the tepid analyst sentiment overall and those liquidity concerns we discussed, and it really reduces its appeal for both short-term traders and maybe even long-term investors right now.
So wrapping it all up, what does this practically mean for someone listening right now, maybe considering an investment in Paramount Skydance? Is it a buy or not?
Based on this assessment, the investment horizon looks neither highly attractive for short-term trading nor particularly compelling for long-term investment at current levels. It seems best suited, perhaps, to very defensive, maybe deep value-oriented investors. Someone who is willing to bet on a broader eventual sector turnaround, or maybe hoping for another potential merger or acquisition event down the road. But the general outlook, based on the material we've reviewed, is best described as, well, cautious. Very cautious.
A truly cautious outlook for Paramount Skydance, then. Despite finally getting that incredibly complex merger done, it really is a stark reminder, isn't it, that even these major established media players face a really steep uphill battle in this rapidly evolving landscape.
Indeed it is. And this particular look into Paramount Skydance, I think it really highlights the challenge of trying to value companies in industries that are undergoing such massive transformation. Where the historical metrics, the old ways of looking at things, don't always capture the full picture of future potential or future risk. It really makes you wonder how long these traditional media giants can keep navigating these pretty turbulent waters, even after making big moves like this consolidation effort.
Yeah, definitely a lot to think about there. Thank you for walking us through all of that complexity. Hopefully this has given everyone listening a clearer picture of Paramount Skydance and where it stands today. And just one last reminder, please don't forget to subscribe, like, and comment if you found this helpful. It really supports what we do. And if you have a company you'd like us to examine next time, or if you just want to support the analysis we provide, you can always buy us a coffee. The link is usually below. Until next time, stay well informed and happy investing.